Statement of cash flows in details. The statement of cash flows is a financial statement that provides information about the cash inflows and outflows of a company during a specific period. It helps stakeholders understand how a company generates and uses cash to support its operations, investments, and financing activities. The statement is divided into three main sections: operating activities, investing activities, and financing activities. 1. Operating activities. This section focuses on the company's core business operations. It reports the cash flows resulting from the day-to-day activities of buying and selling goods and services. The main components include: 1. Cash received from customers for sales. 2. Cash paid to suppliers for inventory and other operating expenses. 3. Cash paid to employees for wages and salaries. 4. Interest and dividends received and paid, classified as operating if the company is in a financial institution. 2. Investing activities. This section pertains to the company's investments in long-term assets and other financial instruments. It includes transactions involving the acquisition and disposal of assets not held for resale. The main components include: 1. Cash used for the acquisition of property, plant, and equipment, capital expenditures. 2. Cash received from the sale of property, plant, and equipment. 3. Cash used for the purchase of investments such as stocks, bonds, and other securities. 4. Cash received from the sale of investments. 3. Financing activities. This section focuses on the company's capital structure and how it obtains funds from investors and creditors. It includes transactions related to the company's equity and debt. The main components include: 1. Cash received from issuing common stock or other equity instruments. 2. Cash received from borrowing money, issuing bonds, taking out loans. 3. Cash paid for dividends to shareholders. 4. Cash paid to repay borrowings. Preparing the statement of cash flows. To create the statement of cash flows, the indirect method or direct method can be used. 1. Indirect method. This method starts with net income and adjusts it for non-cash items and changes in working capital to arrive at the cash flow from operating activities. 2. Direct method. This method directly presents cash inflows and outflows from operating activities, such as cash received from customers and cash paid to suppliers. Statement of changes in equity. Statement of shareholders' equity in details. Details about the statement of changes in equity, also known as the statement of shareholders' equity. The statement of changes in equity is a financial statement that presents a summary of the changes in a company's shareholders' equity over a specific period. It helps stakeholders understand how the equity section of the balance sheet has changed due to various transactions and events. This statement provides valuable information about the company's retained earnings, additional investments, dividends, and other equity-related activities. Here's a breakdown of the components typically found in the statement of changes in equity. Opening balance of shareholders' equity. This is the beginning balance of shareholders' equity at the start of the period covered by the statement. It's the ending balance of equity from the previous reporting period. Net income, or net loss. The net income from the income statement for the period is added to the opening balance of shareholders' equity. Net income represents the company's total revenues minus its total expenses during the period. Other comprehensive income, OCI. This includes gains and losses that bypass the income statement and are reported directly in equity. It can include items like foreign currency translation adjustments, unrealized gains or losses on available-for-sale securities, and changes in the fair value of certain derivatives. Total comprehensive income. This is the sum of net income and other comprehensive income. It reflects the total change in equity due to operating and non-operating activities during the period. Capital transactions. Any changes in the company's share capital, such as issuing new shares or repurchasing existing shares, are reflected in this section. Dividends paid. The amount of dividends paid to shareholders during the period is deducted from the total comprehensive income. Dividends are typically paid from retained earnings, reducing the company's equity. Other equity changes. This section accounts for various other changes in equity that may arise during the period, such as adjustments related to changes in accounting policies or corrections of prior period errors. Closing balance of shareholders' equity. The closing balance of shareholders' equity is the sum of the opening balance, net income, or net loss, other comprehensive income, capital transactions, and other equity changes, minus dividends paid. Details about notes to financial statements. Notes to financial statements, also referred to as footnotes or disclosures, are an integral part of a company's financial reporting. They provide additional information and explanations that complement the numbers presented in the main financial statements. Here's a closer look at their importance and what they typically include. Accounting policies. Notes to financial statements often outline the company's accounting policies, which are the principles and methods used to prepare the financial statements. This includes details about revenue recognition, depreciation methods, inventory valuation, and other key accounting decisions. Significant accounting estimates. If certain financial amounts require estimation, e.g., allowance for doubtful accounts, impairment of assets, these notes disclose the assumptions and judgments made by management in arriving at those estimates. Contingencies. Companies may face legal disputes, warranties, or other uncertain situations that could have a significant financial impact. Notes provide details about these contingencies, potential outcomes, and the potential financial effects. Related party transactions. If the company engages in transactions with its key management personnel, affiliates, or other related parties, these notes disclose the nature of the transactions and any outstanding balances. Leases. For companies that lease assets or are lessees, notes may provide details about lease terms, payments, and arrangements in compliance with accounting standards such as IFRS 16 or ASC 842. Revenue recognition. As revenue recognition rules can be complex, these notes explain how the company recognizes revenue from sales, services, and contracts, especially if the recognition pattern is not straightforward. Employee benefits. Information about pension plans, retirement benefits, stock-based compensation, and other employee benefits is often included in these notes. Fair value measurements. If the company has assets or liabilities measured at fair value, these notes disclose the valuation techniques used and provide insight into the determination of fair values. Segment reporting. If the company operates in multiple segments or geographical regions, notes might provide a breakdown of revenue, profit, and assets for each segment. Subsequent events. Notes may include events that occurred after the balance sheet date but before the financial statements were issued. Depending on the significance of these events, they could require disclosure or adjustment of the financial statements. Income taxes. Companies detail their income tax expenses and the effective tax rate, along with any deferred tax assets or liabilities, in these notes. Earnings per share. EPS, for companies with publicly traded shares, notes may include the calculation of basic and diluted earnings per share. These are just some examples of the types of information that can be found in the notes to financial statements. Their purpose is to provide transparency and clarity to users of the financial statements, helping them understand the context, assumptions, and potential risks behind the numbers. Notes are an essential part of financial reporting and contribute to the overall completeness and accuracy of the financial information presented to stakeholders.